Welcome everyone to today's webinar. My name is Abhishek Sharma, Managing Partner with Everest Group, and I co-lead a lot of our work in the commercial and solution analytics space based out of our New Delhi offices.
Hi everyone, nice to meet all of you. My name is Ricky Sundrani. I'm also a partner at Everest Group as part of the same team as Abhishek and rest of the others on the team. I specifically lead a lot of our work around cloud, infrastructure, cybersecurity, digital workplace related deals based out of our London office in the UK.
I'm Sumit Kumar. I'm a practice director in the firm and manage our work around cost and location optimization engagements with both sides of the houses, be it enterprises and providers, based out of the New Delhi office.
Hi everyone, I'm Rahul Gehani, partner at Everest Group, and I assist clients on topics related to price and contract benchmarking, strategic engagement reviews, and sourcing cost rationalization. Okay, before we dive into the webinar today, let me quickly outline what we'll be covering in the session. So we'll start with a look at how global services demand is evolving. So what's driving growth, where we are seeing slowdowns, how are enterprises evolving their sourcing strategies as a response to that. And next, we'll unpack the cost and pricing trends that we are observing across offshore, nearshore, and onshore markets, and how those are likely to evolve further in 2026. From there, we move into the impact of AI on deal solutioning, how it's reshaping delivery models, commercial constraints, etc. And finally, we'll wrap up with a round of Q&A. So with that agenda in mind, let's begin with how global services demand is shaping up. Okay. Let's start by setting the market context over here. So global services demand has moderated over the last year, influenced by a mix of macroeconomic uncertainty, geopolitical tensions, as well as technology-driven efficiencies. And what we are seeing is not a complete collapse in demand. We look at it as a rebalancing. Enterprises are becoming more selective, more value conscious, and increasingly focused on deriving productivity improvements rather than achieving pure scale of outsourcing. Now, the chart on the left indicates that the overall headcount growth across IT services, business process services, and engineering services has definitely slowed down, over the last few years. The rise of AI-driven automation and improved productivity per FTE are key contributors over here. At the same time, sourcing strategies are evolving. Enterprises are expanding global capability centers, especially in offshore and nearshore locations, as they look to bring in critical digital and AI capabilities closer to their own organizational control. Providers, on the other hand, are streamlining delivery models, optimizing utilization, revisiting cost structures to maintain profitability in a price-pressured market. In short, we are seeing a shift from a period of rapid growth, which we saw a couple of years back, to a period of disciplined, value-led expansion, where AI and automation become key to the overall discussion. If you move on, now let's have a look at new delivery center activity, and that kind of makes the story even clearer. Offshore and nearshore setups have stabilized. We are seeing roughly 400 to 415 centers being opened this year, compared to almost 490 2 years back. So what's driving this moderation is not lack of confidence, but it's a pivot in the sourcing strategy, of various organizations. Global capability centers, or GCCs, are taking center stage. GCC demand continues to rise even as provider-led expansion slows down. And enterprises are looking to retain tighter control of critical delivery as well as AI innovation capabilities. Providers, on the other hand, are being more selective in modernizing their existing sites and consolidating talent rather than focusing on pure footprint growth, which was the norm a couple of years back. And another factor influencing this trend is no doubt AI, as automation and agentic tools compress the need for entry level work, companies are repurposing existing capacity instead of adding more people or more centers. So the key takeaway here is that sourcing landscape is recalibrating and it's not really contracting. The GCC momentum remains strong and the provider ecosystem is realigning itself to the new ways of the world. If you move on further, what we'll see on this slide is the impact of the current market conditions is visible in the growth rates of leading service providers. So the organic constant currency growth, which once comfortably sat in the high single digits, early double digits, it has now dropped notably across most firms that we see on this chart. Providers are dealing with pricing pressure, delayed deal closures, cautious enterprise spending. All the while, they're also trying to manage the disruptive impact of AI on their delivery models. And interestingly, what we are seeing is a growing divergence between a few different categories of providers. On the one hand, we see tier one providers leveraging large renewal deals, co-innovation programs, and AI partnerships to remain resilient. On the other hand, mid-tier firms are finding opportunities by being more agile, especially in specialized domains such as data engineering, cloud modernization, or in industry-specific areas as well. So the key takeaway is that the traditional growth engines are slowing, from a provider perspective. We are in a buyer's market right now. Enterprises do have greater leverage in negotiations and are prioritizing transparency, productivity, and measurable business impact. Okay, with that, let's get some inputs from the audience. Abhishek, over to you.
Thanks, Rahul, for the interesting market context. Right, there's I mean, pretty interesting themes to visit there. So, before we get into explaining, what we believe are the themes, we'd request the audience to contribute to this poll. So maybe we can start the poll. Yeah. So please pick your top three themes which you believe are defining the global services market landscape. And even though the audience can't see which direction it's going, Rahul, there are two letters which I see which form an acronym, which is not really surprising as it seems to be ruling the roost, right? What do you think, right? Does that come as a surprise?
No, I mean, in fact, if you look at it, even in the last two, three slides,
Yeah,
I must have used those two acronyms, at least six, seven times, so not surprising at all, that AI infusion is seemingly, the biggest parameter that people are opting for over here.
correct. Okay. So let's go ahead and share the results. So there was quite a lot of options. So what really comes out on top, if I were to look at it, is the AI infusion. That was the two-letter acronym we were talking about. Clearly seems to be driving a lot of stuff. And I think the related part is also how we get to, you know, basically how to manage the cost and pricing pressure. And those two really go hand in hand, Rahul. What do you say in terms of, one leading to the other? Yeah,
Absolutely. And again, it's kind of a precursor to some of the content that we have in the follow-up slides, but yes, absolutely. AI infusion and outcome-based deal, being the top two responses, not surprising at all.
correct. I think the one thing where we have a contrarian view is sole sourcing. But like you said, maybe we go to the next page and share our view of what those top five or maybe six are, and we talk through that. Okay, so again, supplier consolidation is what we see as theme number one. I guess what's happened is that over the past many years, there was a diversification of suppliers, either certain business units going after them, or for talent demands, given the cost pressures which organizations are facing today, and the desire to streamline and concentrate spend to get the most in terms of service delivery and commercial tenets, there's a lot of movement uh, to move to a smaller set of preferred suppliers and then use them to drive transformation, drive initiatives, get better use of AI, get better AI related commitments around that. So we are definitely seeing supplier consolidation. Sole sourcing, interestingly, didn't come out very prominently in the poll, and I'll admit, it wasn't surprising to me. It's not the most exciting thing in the market, but at the same time, there are many instances where clients, buyers don't want to change the incumbent supplier, but at the same time, they're a bit concerned that they might be lagging behind the market in terms of commercial or solution elements. But then, they are thinking of innovative ways to ensure the deals are retained, but they stay in line with market standard commercials. And some of this is possible through proactive reviews, third party assessments to make sure that, they get the best of both worlds. It is a buyer's market. There's significant pricing pressure, maybe to the extent of calling price wars, leading to unforeseen, financials for commoditized scope. But at the same time, for highly complex scope, right? Even though yes, there is competition, we may not see as much of a war as such. But again, there is a lot of focus on getting to the right commercials for that. Outcome-based constructs, there's been a lot of talk around that. There's been a lot of conversation. We recently had our Engage event in Dallas, recently one in Bangalore as well. So over the past 3 to 4 months, we've had multiple instances of being face-to-face with a large number of enterprise clients. So while there is desire for clients to explore what outcome-based constructs are, the complexity tends to kind of hold them back. So people are exploring simpler ways in which, hey, the core pricing model might be something standard like a fixed fee, T&M, output based, but there is some degree of outcome linkage which is linked to a business outcome or something which or some behavior which the client wants to drive. So there is a much of a focus on simplification of those. I won't talk much about AI infusion, but the conversation is moving from, hey, don't tell me what the overall benefits of AI are and what great things it can do or the art of the possible. There is a lot of interest to figure out what's the impact on solution, commercials, and user experience, and how that would imply and how that would play out through the journey and the objectives which clients are trying to achieve, right? Which makes for a relatively sober, interesting yet sober story as compared to, hey, AI is going to change the world. People have had enough of that magazine level talk. So we spoke about five, but as we're in 2025 and we're talking about sourcing, how can we leave aside GCCs, right? So provider assisted GCC setups is the sixth wild card, as I may call it, as a theme defining the global services market right now, right? So the pace of GCC setups overall is unprecedented. And many of them today are happening via build, operate, transfer, assisted captive, or some other innovative options. So if you move to the next page, right. So this is our sixth theme. There is a rapid rise of provider-assisted GCCs, which is reshaping what we call enterprise delivery strategies, right? So if you see the table on the left, right, um, you know, it's 15% CAGR of the overall market, about 6% CAGR over the next sort of 3 years in the number of GCCs, and the overall headcount employed across offshore and nearshore geographies expected to go up from 2.8 million in 2024 to almost 4 million in 2027. So that's the overall, GCC numbers. I spoke about the whole provider assisted aspect. The service providers have as much of a role to play across multiple aspects. We could look at carve outs or acquisitions. The GCC setup space is literally exploding with provider assisted mandates. Same is the case with GCC transformation. And then GCC operations, which is the ongoing support that's provided, has been pretty constant, but it seems to be tapering out, right? But effectively, not surprisingly, the maximum growth we're seeing is in the GCC setup and transformation space, where providers, almost all providers, have actually set up specific business units just to target the GCC setup transformation space, and they're building up large teams dedicated to that.
And Abhishek, there is actually a very timely question that has come from one of the webinar participants as well, very relevant to what you just talked about.
Mm-hmm.
The question goes like, is the overall GCC market, is it being very overhyped? And is the market expected to cool off in 2026, 2027 as companies start seeing there will be challenges around hiring, especially in India when we talk about top talent? So
Yeah.
what's your view around this one?
Yeah, that's a good question, Sumit. See, in practicality, there will be some GCCs that will eventually struggle, right? And it's not just due to talent. Talent availability could be one factor, but it could be because of changing priorities, maybe some lopsided business case assumptions that were taken, or even poor operating model design, right? It's operating a GCC, even if it's provider assisted, once you take on the reins, there's multiple challenges which could come your way. Now, having said that, the focus with which most firms, I won't say all, most firms are entering the market, the level of internal diligence that they're doing, and the leadership support and mandate that they're getting, I won't see the GCC story fizzling out at a macro level, right? At least in the near future, because I foresee that a vast proportion of the GCCs will have moderate to a high level of success. There will be a few things which don't work out, but I don't see that fizzling out, at least in the near future.
Okay.
All right. So if we move to the next page, that brings us to what we've discussed. We've set the context on demand evolution, different formats of that, the themes in 2025. But I think now is the time to get into the second section. So Sumit and Ricky, why don't I request you to just talk through some of the direction when where cost and price have taken this year and what we see as the outlook into the future.
Sure. And thank you so much, Abhishek. Now, this was one of the theme as well that we discussed in the poll that cost and pricing pressure continues to be there. And that's what we are seeing in the market as well. So in offshore market, for example, from a cost standpoint, we saw that 2025 was another year of upward movement in costs, with spikes primarily concentrated in digital and AI heavy roles. So roles like AI engineers, ML specialists, they demanded quite higher salary increases. Outside the tech spectrum, we are seeing steady cost increase in non-voice BPO. Voice BPO, by contrast, has been quite stable, with cost inflation coupled only for AI-assisted CX tool work. Even in consulting linked delivery, when it comes to advisory and transformation pods based offshore, they have seen cost increases as firms add domain depth and digital fluency. Going forward, this cost pressure is going to be there. That's going to be a challenge. And I know, Ricky, you'd want to share some insights on how you're seeing things around price and how that ties up to the deal margins as well.
Yeah, absolutely. Thanks, Sumit. I think when it comes to pricing, this year has been marked by relatively flat to negative growth for rate cards across most of the skills, which is unlike what we saw last year because we did see some bright spots last year where certain areas or certain skills continue to sort of command a premium and continue to witness an increase. We did see that, but the increase or the quantum of increase was relatively much more muted compared to the last year. Say even in some of the high demand skills like cloud and cyber, which we did not see a big jump this year. I think, however, interesting to know that, and probably not a surprise, but we're seeing the AI related skills commanding a significant premium, and we are also seeing emergence of newer roles like, let's say, a responsible AI and a governance specialist, an AI security specialist, AI test engineer, AI orchestrator, right? All of those skills which require you to have a very hands-on knowledge of AI and being able to use it to augment what you're already doing. And I think the hottest of that is all, and everybody's been talking about it, as a forward deployed engineer. So um, I generally speaking, I think given the rate cuts have remained flat or gone into negative territory, but the costs have actually continued to rise, as Sumit mentioned. Had it not been some of the significant cost optimization initiatives that service providers had undertaken over the last couple of years or so, say for example to optimize their overheads, bench, SG&A costs, we would have definitely seen margins actually decline significantly because of that. But impact of margins has not been that significant. I think you'll also see in a lot of cases it's largely remained flat or gone in the slight negative territory. It's not a big impact to really speak about. But having said that, I think margins have also been impacted not just by the dichotomy in terms of the costs going up, prices remaining flat, but the other major driver of it has been the intense price war, or the competition, intense price competition that we've been seeing in the market over the last 6 months or so. I think we've seen deals getting signed at significantly competitive rates, deals getting renewed at much lower prices than they were last year. So that's starting to impact some of the margin for service providers. Um, Having said that, I think Sumit, do you want to talk about how the trend has looked like at nearshore?
Yeah. So on the next page, the nearshore location, and by the way, I want to clarify this nearshore is both for nearshore Europe and the Latin America market. So the likes of Poland or Romania for Europe, or Mexico or Costa Rica, all of them aggregated across. Nearshore markets, the cost story has been relatively contained now across be it Latin America or Eastern Europe. The cost increase has been there. Like an offshore location, primarily concentrated in digital and bilingual delivery roles as well. At the same time, currency appreciation has also played its role, which has amplified FTE costs in some of these markets. Going ahead in 2026, we expect costs to stay elevated for high-end roles, particularly in AI, ML, cloud engineering, because be it Eastern Europe or Latin America, the talent is quite difficult to scale at source in all of these markets for digital skills. On the BPO side, on multilingual delivery, we expect that the cost base should remain largely stable. That's what we see from a nearshore side. And moving to the next one, we have the onshore, which is primarily our source markets. Now, taking example of US tier 2 cities over here, it's a different story. Not very different on the cost side, but at an aggregated level, again, it's you will see a different story. For example, cost escalation here has been quite broad-based for specific roles. Ricky took examples of AI security, responsible AI. These are some of the roles which we saw great traction in onshore markets and also saw significant cost increases. Demand has far outpaced supply in these markets, especially when it comes to AI expertise and also on hands-on engineering or consulting depth.
Yeah.
In BPO space, we are seeing for traditional voice and non-voice operations, the costs hold steady, while for consulting and SI teams, particularly those in digital transformation or change management, they continue to experience cost inflation driven by strong market demand, ongoing wage competition with hyperscalers, digital AI first companies are coming up. So all of this is leading to competition on the cost side. Ricky, what's your view from the price side and the overall deal
Yeah,
margins?
sure. I think very similar trend as what we saw for the offshore-based markets, right? Um, I think generally speaking, more on the price war conversation or the intense price competition that I was referring to. Um, I think the point is that does not always take the shape of more discounts, right? For example, we are increasingly seeing in a lot of deals where vendors are agreeing to a flat zero increase in the rate card from the previous year or the previous 2 years, in fact, especially in large deals, right? Especially, and you look at any deal which is greater than $150 million in overall total contract value. We observed an increasing frequency of buyers negotiating COLA freezes for the first 12 to 24 months of their new contracts. And generally speaking, over the last 18 months or so, I think ongoing geopolitical tensions, macroeconomic uncertainty, trade disruptions, and supply chain stability have made clients generally very cautious. And so we've seen a significant reduction in terms of the proportion of deals that now include an automatic COLA clause, right? So earlier they used to have this, but now it's all it'll be the price increase or changes will be subject to a governance discussion. So we're seeing those trends largely play out in the market.
And Ricky, there was one question which came on the previous page actually, but I think it's very relevant even for this entire section. So the question goes is that what components do you foresee that will be most affected in 2026 or 2027 deal negotiations? And how should organizations prepare to mitigate the financial risks around that? So I think it ties well with what you just spoke. So if you can
Yeah.
share
So
some thoughts.
I think what has happened is the last couple of years, service providers have done a lot of internal cost optimization initiatives in terms of, I mentioned, optimizing overheads, SG&A, all of that, right? So increasingly, I think we're also seeing more and more providers bring in a leverage AI as part of their deal pursuits to sort of further help down reduce overhead costs. So second, we're seeing a sizable impact of AI in productivity, and we'll talk about it in the coming slides. But that impact of productivity right now, this is right now is impacting deal margins, right? In the short term, we're seeing providers are sacrificing gains to retain accounts and business, right? For example, if they're offering say a 30% efficiency gain over a 5-year period due to AI, they're not at this stage focused on necessarily recovering the cost that has gone into building that AI IP or platform, right? So, but in the long run, I strongly believe that uh, service providers will find a way to improve their margins and make more money out of this. So it won't be always like this, right? It's existing now because we are in a buyer's market, and if they realize that if they don't do it, someone else will. But eventually, I think in the next, say, 2 to 3 years, I definitely feel service providers will be able to start making a premium out of the AI accelerators, AI IP that they are building, and embedding it into various delivery constructs. So I think uh, not surprisingly, AI will be one of the most spoken about levers going forward in any outsourcing contracts. How do you price for it? How do you impact? How do you bake in the efficiency impact that AI brings to your deal and all of that? So it'll be interesting times once we go forward. Um, if we just now move on and talk a bit about, given that we've been speaking a bit about how AI has impacted deal solutioning, again, want to sort of open the floor to the audience and want to understand more in terms of the people who are on this session today with us. Have you started to embed AI into your deal solutioning? So the options here are you doing it very actively in almost every deal as part of the deal solutioning and delivery? Are you doing it partially in selective AI and pivoting selective AI use cases in deals, or are you still at a planning stage where you have a roadmap and you say plan to implement it going forward in 2026? Or are you still at a stage where you're evaluating what AI applications make sense for my clients, and but there's no definite concrete roadmap to actually roll out, or you're not considering any AI in deal solutioning? Um, Having said that, Abhishek, what's your take? Being part of so many recent deals, how are service providers baking in embedding AI or not embedding AI for that matter into recent outsourcing contracts?
Sure, Ricky. So one of the things which clearly over the past 12 months, if there's any deal of a decent size, right, or at least any kind of a competitive, anything which involves competitive tension, we're definitely seeing a much clearer view of how AI is going to be used, what are the financial and what's the overall outcomes which folks can expect. Now outcomes here I'm defining more on the financial side, maybe not as much on business as we talk through, but definitely it is front and center of, I'd say, any deal which is of consequence,
Yeah.
right? Speak. Yeah.
And I think the results show it as well. I mean, nearly 2/3 of the audience here as well also are at the stage where they are actively embedding AI into deal solutioning and delivery design, or actually at least trying to do it partially in select use cases or select accounts. So I think that's heartening to see that there's definitely change on the horizon. And of course, there are a few who are still at the planning stage, but this is heartening to see in terms of how the industry is moving forward. So, what's our take in terms of how AI is getting embedded into deals, right? So, if we move forward and talk a bit about, so I think there's generally a conception, or rather a misconception, that we see in today's sourcing world, right? That buyers believe that it is the supplier's job to sort of sprinkle AI into the deal like some sort of magic topping, and that alone makes your offer competitive, right? But the fact is that as a buyer, if you don't stress test how AI is actually embedded into the delivery, the commercials, and the outcomes, all you get is really PowerPoint, glossy PowerPoint slides, right? And no one wants to go back to the CFO to explain that those AI savings are still stuck in a slide deck. So the point is, how do you cut through the gloss and make sure that AI is actually the provider, what they're proposing is actually working for you? So what we recommend is doing asking 4 sharp questions, and we call it as the AIMS test, because every deal with AI should be aimed at delivering real value. So the first is really, how does AI impact the application layer? How does the AI impact my solution? What's committed? What's contingent? How does it change the solution effectively? I stands for interaction. How does AI change the overall client experience, or rather stakeholder experience, right? Both positives and negatives. M stands for money, of course, the most important bit. How does it affect the deal commercials, any upfront investments? What does it result in terms of fee reduction, any outcome linkages, and so on? And then finally, I think a very important bit, surprises, right? What sort of uncertainties, risks, or dependencies that you should be prepared for that could derail some of the promised value that AI has, right? So when you put your suppliers through this AIMS test, you start to separate the marketing hype from the execution reality, right? And now let's move from theory to evidence to see what does AI infusion actually do to productivity when we look at 3-year deals. So if we move on and talk a bit about some actual impact of AI that we're starting to see in different functions. So let's start with application testing services. So standard levers like automation framework, continuous improvement, they will typically give you that 18 to 20% productivity. Now you add AI on top, self-healing scripts, autonomous test generation, and you get another 18 to 28%. Together, that's like a massive 36 to 44% uplift, right? So in simple terms, it's almost doubles the efficiency compared to traditional levers alone. Similarly, if you talk about business process services, if I look at finance and accounting, order to cash, where AI is really rewriting the traditional playbook, your typical traditional levers will give you about 24 to 26%. But when you add in AI things like intelligent, so what you add in things around intelligent document processing, AI Copilot for agents, predictive cash flow management, you gain another 7 to 12%, right? So that's a massive 31 to 38% in total, a level of impact that frankly would have been unthinkable even a few years ago. And the point is that in conclusion, standard levers definitely still matter, right? They're not going away. You can't skip the basics really, but AI acts like a multiplier. It takes what you already do and lifts it higher. So in some areas like application testing, it's not just incremental, like it's transformational. So having spoken about the impact of AI and spoken about where does productivity come in, let's talk about how does it change my overall labor pyramid, right? Because for long everybody's been talking about moving from that pyramid shape to diamond shape pyramid. So, and my colleague Sumit has done some great research on it. So, Sumit, if you can share a bit more.
Sure. Thank you so much, Ricky. Now, this is where we start seeing on the next page how AI is fundamentally reshaping the workforce structure and talent pyramid that we used to know for years. Traditional delivery models, whether in IT or BPO, they were organized around a classic pyramid, a broad base of entry-level talent, a smaller middle layer of project managers and architects, and a thinner top of strategic roles. Now that structure is evolving and quite fast. What we are seeing across markets is that this pyramid is flattening at the base, expanding through the middle. Now, in IT services, for example, as AI takes on repetitive coding, testing, documentation tasks, the demand is shifting upward towards mid-tier engineers, solutioning talent who can bring some business context, domain depth, and oversight into AI-driven workflows. So instead of a traditional pyramid, many delivery organizations are starting to look more like a diamond, with the heaviest concentration of talent sitting in the middle. Now, these are the experienced practitioners who can validate outputs from AI systems, handle edge cases, drive contextual decision making. Now, in contrast, if you look at BPO, the shape changes in the opposite way, what we call a flask model. Now, here, automation is compressing that middle layer, where much of the reporting and analytics work used to happen. While the base layer entry-level roles handling exceptions or complex customer interactions remain relatively intact. Now, the key takeaway from this page would be that the shape of the workforce is no longer one size fits all. It varies. It varies by function. It varies by maturity, and across the board, AI is redistributing work now, compressing entry-level layers, elevating mid-tier talent into a more central solutioning role. Now, this is what our research says, but on the next page, when you start seeing what is happening on the ground, you will see these early signs of the shift are already visible in the market. As you can see from some of the headlines on the left side of the page, over the past 12 months, we have seen a sharp reduction in entry-level hiring, especially by IT and outsourcing firms in India, the Philippines. Many companies have cut fresher intake by more than 30-40 percentage points. Now, this just isn't about slowing demand. It's about a structural shift in how organizations are thinking about workforce design. With intelligent system managing routine workflows, verifying invoices, processing claims, handling reconciliations, the need for high volume work or entry level hiring is naturally declining. Instead, hiring has become very selective, skill based, focused on talent who can supervise, interpret, and augment AI driven work. Now, when we start thinking from the next perspective around the shoring mix, which is on the next page, you will see that the workforce shift is starting to influence your overall location and delivery model. Historically, delivery was dominated by offshore heavy models, especially in technology services where 60-65% of the headcount used to sit on offshore. But as AI changes the type of work being delivered, that equation is starting to rebalance. Now, our latest research shows that as AI matures, and again, there are a lot of investments happening and firms expect them to mature going forward, the total delivery headcount will shrink. Earlier, you required around 100 people to do the same level of work. But going forward, you might require 75 to 85% to do that level of work, due to which there will be some changes in the shoring as well, where we expect slight decline in offshoring. You might ask why. Now, it's because as automation takes over more volume-driven work, which continues to remain offshore, so that work will see a lot of the higher context oversight roles will continue to stay, but the roles which are more volume-driven, transactional nature, those might see some movement or retraction as well. Now, we are already seeing early examples of modest rebalancing happening. So, in short, AI is not just reshaping what work gets done, but it's also reshaping where it gets done. Offshore centers will continue to be critical, but the purpose will evolve from pure scale to specialized AI-enabled execution, while onshore and nearshore centers gain relevance for contextual, high-trust, compliance-intensive tasks. With that, I would ask Rahul, who would want primarily to cover the next page on AI-driven shifts in pricing, the deal dynamics. Rahul, do you want to take this up?
Sure. Thanks, Amit. So let's have a look at how AI is shaping outsourcing pricing and deal dynamics. So when we kind of look at how AI has been impacting deals, it's not really just a cost reduction story. AI is changing how services are structured and monetized. Pricing models are shifting from headcount and effort to outcome, automation, and platform value. We are seeing prevalence of hybrid constructs as well, having base managed services fees combined with outcome-based components laid on top. We're also seeing, in some cases, subscription tiers or usage-linked pricing for digital or AI agents. At the same time, clients are demanding a clear ROI and faster payback. This is in line with what even Ricky was implying a couple of slides back. While providers are embedding value realization frameworks and productivity commitments directly into the proposals, clients are having a clear focus on, ultimately, if they are investing $100, on AI, what's the actual savings or let's say the benefits in terms of business outcomes for them. And as a result, we are also seeing governance discussions evolving. Contracts now really spell out the dependencies around data quality, process maturity, and co-investments, recognizing that AI success requires shared accountability. And lastly, we are also seeing a new set of deal metrics emerging. There are definitely outcome linked SLAs, XLAs, as well as AI specific KPIs that measure business impact and not just the operational efficiency. So in short, AI is turning outsourcing deals into value-based partnerships, where success is measured by tangible business outcomes in many cases.
I think just to add to this, I think Rahul, and this is the question I think we are getting in different many shapes and forms, is around what pricing models are outsourcers really using to monetize the value of these AI platforms they're bringing to the table, right? It could be zero touch support, it could be anything, the insights that you are deriving from that. How is that, since those are becoming integral part of the overall service solution, have you seen any early signs of how a service provider is starting to price those out or monetize some of those?
Yeah, absolutely. In fact, it's a great segue to the next slide. We are talking about that. So if you kind of focus on the pricing models, and how they have been evolving. So there's already been a good degree of transition that we have seen till now. As illustrated on this slide, we are moving from the traditional headcount-based billing models to AI agent and outcome-based models. So, for example, if you focus on the three columns on the right side of this slide, how providers are really trying to monetize in some of those aspects, Ricky, would be, we have seen prevalence of AI agent or digital FT pricing. In other cases, we have seen a bundled team rate, which essentially is a combination of the human FTEs plus the digital FTEs or the agents. And we are also seeing hybrid models, which essentially mean it's a combination of traditional pricing, which all enterprises, all providers have been used to all this while. But in addition to that, AI-driven constructs, and essentially mixing the two or more approaches. So, we are not saying that the traditional models are completely going away, because, just to be sure, we still see traditional time and material pricing, being a key pricing model. I'll say majority of the deals today, continues to kind of have such kind of models. The only point over here that we're making is, there's already a fair degree of transition, and in the coming months, in the coming quarters, we expect this trend to continue as well. So if you kind of now look at what's really driving this shift in the pricing models. So let's move on to kind of focus on that. There are several forces which are kind of ultimately leading to this kind of a change. First, the commoditization of traditional services. As automation and AI take hold, baseline delivery is no longer a differentiator. Second, intense competition, from hyperscalers, from mid-tier providers, from consulting boutique firms, as well as AI native startups. It's all putting pressure on some of the already established, providers out there on their margins and forcing them to come up with creative commercial constructs. Third, the client expectations themselves have evolved. Clients want flexibility, faster results, and contracts that tie value to measurable outcomes rather than rigid resource commitments. Procurement teams are also playing a bigger role, in this entire process. They're pushing for a clearer ROI articulation and a faster payback for investments around AI. And lastly, when it comes to the productivity dividend from AI, what we are expecting or what we are seeing is that clients are expecting providers to share these gains transparently through pricing adjustments or outcome linked structures. So together, all of these drivers are creating a new landscape of pricing models, where flexibility, transparency, and value accountability become very important principles. Okay. If you move on to the next slide, changes in pricing, are also having a lot of effects on the entire deal construct. Various other elements are getting impacted by this. So first, like we have discussed, there's a heightened emphasis on ROI and commitments. Clients want concrete numbers, not just promises. Second, we are seeing a shift from capacity to value, with many deals now linking fee to business outcomes, customer experience, XLAs, SLAs, so on and so forth. Thirdly, the deals are becoming more and more modular. There would be base fees, but they would be on top of that, components around platform subscriptions and AI agent usage tiers. Fourth, the contract clauses themselves are evolving. We are seeing a lot of changes happening in clauses such as data integrity, liability, ownership of intellectual property. We are seeing AI governance, becoming more and more, a standard part of contracts. And finally, suppliers are now being more explicit about the client dependencies. This is something which generally was looked down upon, year back, 2 years back, having too many dependencies was essentially a telltale sign that, a lot of the commitments being made are essentially, not really to be realized by the client, but you know, a situation has changed a little bit. Providers continued with that particular model, and in the process, we have also seen situations where they've burned their hands. And hence they're now insisting on calling out the client dependencies very clearly. So the key takeaway is that as AI becomes central to delivery, contracts are transforming from transactional documents into living frameworks that balance innovation, accountability, and shared value creation. And with that, let me hand it over to Abhishek to walk us through the final set of messages.
Thank you. Thank you so much, Rahul, Ricky, and Sumit. We want to share a message with our enterprise audience. You can sign up for the complimentary price and cost check to gauge, the current status against market and figure out if there is value waiting to be unlocked in your contracted FTE rates or the cost base, as the case may be. To sign up, please do click on the link, which should now be available in the message window, as I can see that. Also, today is a unique day. Please be aware that due to the Cloudflare current outage, this link, if it's not working, please do try again later, or please contact milan.tenan@everestgrp.com, the email that you see in the chat, for assistance, and we'd be happy to help you out. Right. Again, just to be clear, you can choose from two out of the three functions, right? A couple of roles, and then two out of the six countries mentioned to get a complimentary price and cost check. The details are available at the link mentioned. All right. As we move ahead, a few key takeaways, right, from today's session. So first off, yes, fundamentally AI can drive significant outcomes, right? But they mean very little if the commercial construct or model in which they're applied does not make sense, right? It has to be fair, predictable, and transparent. You won't believe the number of enterprise clients who still have a fear in their mind that, hey, we're excited about AI, but we don't know if the supplier is passing on the benefits to us. Are they pocketing it completely? Are we going to be investing a lot and then figuring out that it's not going to give us the ROI? So there's lots of questions, and I think the commercial certainty, which if providers can provide, will ensure the right kind of value to trickle down. Renewals. I mentioned sole sourcing a few minutes back as one of the core five themes that we see. But renewals, in a way, right, can be used to stay with the same supplier, but then there should be openness on both sides to fundamentally re-engineer the solution, commercials, and delivery model. There's a term which we've been using for a long time. It's called the incumbent's curse, right? That the newer parties can just come in and use either financial muscle or the go-aheads that they get from their leadership to win a new account, but then the incumbent has to live with a lot of that. I think there is maturity setting in with a lot of clients who say that yes, there is a risk in transition unless there's a clear reason. They would want to continue, but as long as the provider is also willing to re-engineer. Vendor consolidations are inevitable, but perhaps for the provider community to win at them, it's important to understand the core objective value beyond just rate cards or discounts, and then how strong the executive relationships are, and demonstrated examples of institutionalizing innovation. Those things tend to be a bit more key than, hey, I'll give a better deal, and they'll jump on, right? Finally, while we talk about AI, providers need to work with them to help the client move from labor-based to AI-first operating models. It's not going to happen overnight that everything moves, to an AI model. But then, what are the ways in which, using existing constructs, we can put AI or infuse AI into the game to make it an AI-first model? That is the game, rather than having the slickest and coolest technology to work with. Right. So those were some of the key takeaways. If we move ahead, we'll just take questions in a moment. Yeah, thank you. So we've got a few questions. If there are others, please use the Q&A console. But I think we'll start with one which perhaps Rahul you'd want to take, around what's the extent of accepting vendor-specific AI tools in the environment, specifically the client environment.
Right. And I think there's a follow-up question also on the same lines, which is, is there a preference for third-party AI tools? So, what we are seeing is, as one would expect, we are seeing both types of situations. There are clear, the clear examples where enterprises are preferring third-party AI tools, because there are concerns that if they go with vendor-specific AI tools, the client will get logged in with a particular vendor, and hence it makes sense to go for third-party AI tools. Now, the flip side on that is, you look at any large AI company, the kind of contracts that they typically have, they are actually very, very watertight, and in favor of the vendor. So, on the flip side, therefore, what we are seeing is, clients who are evaluating going with the third-party AI tools, but ultimately still deciding to go with the vendor-specific AI tools. So essentially, it's a mix. Different clients have different motivations.
Thank you. Another question which came up during the discussion was that, and this is linked to outcome-based pricing. Providers and clients have been struggling with ambiguous outcomes, right? How do you identify due credit, the allocation, right? What's the audit trail? And true, it's been more talk than action. Now, how does that change with the inclusion of AI? I'll take this one. So, to be honest, identification of what those outcomes are still is complex, right? That doesn't change what the client wants, and how do you measure that, and who's accountable for what. The only thing which has changed with AI, and we hope to see some part of that sooner, is that even despite some degree of confusion, because of the use of AI, the dependency, because human effort is hard to quickly scale up and scale down. One of the most impediments to such kind of complex pricing models is, hey, what do I do with the capacity? I can't simply deploy elsewhere because I need to pay my people salaries. With AI, which we have more of the asset based delivery, the ups and downs can be managed better. So there is some more flexibility to take on additional risk related to outcomes. So while the definition may not change per se, just the ability and the flexibility which one will get from a more flexible, highly scalable delivery model might lead to suppliers to take on a little bit more risk when it comes to outcomes. There was one more question around, and Ricky, perhaps you'd want to comment. Do we think AI will impact managed services pricing over longer term contracts? The example used in this was 10 years. I'm not sure if we're seeing many 10-year contracts, but keen to get your perspective on this.
Sure, Abhishek. I think I agree with you. I don't remember seeing a 10-year contract in the last year or so, maybe 1 in 100 situation. But I think generally speaking, we are seeing contracts starting to, I think it's been the trend, tending to be more of 3+1 or 3+2 sort of duration rather than a sort of a upfront 5-year commitment. It's all because of the rapid evolution of change we are seeing in the market. Nobody's able to predict exactly the impact AI will have on managed services or outsourcing services going forward. So most clients are unwilling to commit to those longer terms. Generally speaking, what we also did is we kind of, because we are analysts at heart and we love doing our analysis, we did our projections in terms of, okay, if we take a managed services deal now, and if we kind of do a projection of it to start in 2030, a new managed services deal starting in 2030 versus compare it to a new managed services deal starting now, our analysis suggested that the same deal will be at least 50 to 75% lower in terms of the TCV value. Now, of course, there are lots of ifs and buts and a lot of missing parts to it. I think the 50 to 75% is purely on labor. So we do not include cost of any hardware or assets into it. It also assumes that there will be certain initiatives or transformations taken to get to that state of maturity or implement some of those levers to be able to get to those 50 to 75% lower cost, right? So that's been some of our analysis, and that's largely applicable for a lot of the managed services work that we typically see getting outsourced right now, be it IMS, AMS, and some of that work. So yes, I think at least if not as long as 10 years, but at least in 5 years down the line, we definitely see at least a 50 to 75% reduction on what the deal value will be compared to a deal which is getting signed now.
Sure. Thanks. I think we have time for last couple of questions, and an interesting one came up, Rahul, around what are some of the differentiating factors for mid-tier providers against the larger ones, especially as the larger ones are now following or chasing smaller deals. How do we see maybe a couple of points which to help the mid-tier ones differentiate?
Yep, and it's a very pertinent question because, to be very honest, in the last 2 years, we've really seen the mid-tier providers outpacing their larger peers. Uh, the differentiators which they have been able to bring forth are essentially number one, when it comes to the mid-sized clients, they generally have a perception that if they go to a large service provider, the provider would not really treat them with the right level of attention and importance, and taking advantage of that, we have seen the mid-tier providers really give them, the VIP, the white glove treatment, so that's point number one. Point number two is with regard to, showing the agility to curate their solutions, curate their commercial constructs in a way which is resonating well with the client stakeholders. The mid-tier providers have been able to do a very good job of it. On the other hand, we have seen in a lot of cases, not saying it happens all the time, but in a lot of cases, we have seen the larger, players actually going in with a pretty standard approach that this is the solution, this is the price. So on both counts, there's been a good amount of differentiation which the mid-tier providers have been able to display. Remains to be seen if, in the coming deals, the larger counterparts are able to overcome that.
Sure. Thanks, Rahul. So I guess we're very close to the top of the hour. But before we go, if you move to the next page, just want to take a few seconds to talk about the Engage conference coming up in London on the 9th and 10th of March. And this is something which will convene a really intimate group of senior executives across GBS, sourcing, vendor management, and shared services to solve some of the toughest challenges slowing enterprises down. So this is the second one which we'll be having in London, apart from the ones which we have in Dallas and Bangalore. So please do feel free, in case you're interested, reach out. And there is, the pricing which is mentioned here. So before things get sold out, as our recent Bangalore one was, um, uh, get your tickets and seats in early. With that, I think we're coming to the close of the webinar. Thanks for joining all of us, and have a great day or great evening or great afternoon ahead.
You.
Thank you.